Hi everyone, come on in, make yourself comfortable. We'll get started in about a minute. Come on in, make yourself comfortable. We're going to kick off in about 20 seconds time. Good afternoon and welcome to your June webinar. My name is Jeff Thurrock. I'm a Director of Australian Advice Network and Evalesco, and I'll be your host for today. I'm very excited to be joined by our expert guest. Live and in person with me today is Melody Edwards, Personal Financial Advisor and Superannuation Guru here from Evalesco. Hey Mel, thanks for coming.
Thank you. Thanks for having me.
So we've got a lot to talk about today around changes to super and the opportunities that are coming up. Kicking off tomorrow on the 1st of July, so very timely. But before we get into that conversation, I'd just like to remind everybody at home that you are on mute during this webinar and your video is turned off, so we can't see you or hear you, so feel free to move around. We would love you to ask some questions though as we go along, so you can do that by clicking on the Q&A button down the bottom of your screen and typing in any questions there. So we'll get to those as we go through, or carry some over to the end, time permitting. Most of our conversation today will be of a general nature, talking about general superannuation strategies and concepts. So I'm just going to give you a general advice disclaimer, which just says that even though a lot of people on this call are clients of Evalesco or AAN, we're not taking into account your personal circumstances today. So this is general advice only. If you'd like to discuss anything we talk about further, which we hope you will, because there's lots of good ideas come out of it, please get in touch with your advisor or Mel or myself, and we can steer you in the right direction there. All right, Mel, we'll get into it. There's lots to go through, as we said. So we're going to run through what the changes are that are coming into effect tomorrow, and then we'll come back and talk about some strategy tips, a couple of case studies and a few more things as we go along, which is that slide there. So we're going to start with the first changes around the superannuation guarantee contributions rates. So talk us through this, Mel.
Yeah, so there's been, so from the 1st of July, we'll have an increase of 0.5% of the superannuation guarantee that your employer will pay on your behalf into your super account, and that's part of the measures brought in a number of years back to steadily increase that percentage to 12% as a target. So you'll find that kicking in from 1 July.
And that's something that happens automatically. Don't have to do anything about that.
No, that's right.
It's a good thing to just check though when you get your first contributions in for the new financial year that rate has been applied. I think one other thing is also if you're already salary sacrificing, just to check how that's been impacted and making sure that if you want to, you're getting the additional on top of the 10.5 and it hasn't been taken out of to that effect, which we'll talk a little bit more about when we talk about strategies as well. Mm-hmm. So a few more changes. So the removal of the $450 monthly income threshold to qualify for SG payments. So that's something that doesn't affect a lot of people, and probably not a lot of people on the call, but it's a really important one for lower income earners and part-time workers.
That's right, yeah. So especially where the younger families where the previously primary caregiver might be re-entering the workforce, taking on a number of casual jobs. Previously, if they didn't meet that threshold, they weren't entitled to any super guarantee payments. So now with the removal of that, that should help add a little bit more to their super as well.
So that effectively means anyone getting paid gets super.
That's right.
Yeah, which is great. So the next one is around abolishing the work test for people aged between 67 and 74. So this one's a little bit little bit meatier. So what's that one all about?
So up until this date, if you were older than 67, you needed to meet a work test to contribute any more money into super as a personal contribution. And that essentially meant that you had to work 40 hours in 30 consecutive days in a financial year to be able to then contribute into your super account. So the removal of that requirement is now further opens up the ability to make additional contributions in.
So that includes non-concessional and salary sacrifice contributions. And there are a few, I guess, restrictions and things to be aware of around that.
Yes, that's right. Yeah. So anything that will be claimed as a personal tax deduction will still need to meet the work test between those ages.
Yeah. I think this is one, and there's a few, I guess, that fall into this category where the previous government and the current government are kind of acknowledging that people are in the workforce longer and wanting to keep working to then be able to contribute to super and make changes for their own, retirement planning for a longer period of time. So they're acknowledging that they needed to change some of the rules, because a lot of it used to be, age 60, and then it was age 65, and then, a couple of years ago they increased some of these restrictions to age 67, or removed them up until age 67. So it's a really great step, I think, in acknowledging and supporting people to stay in the workforce and give them some flexibility.
That's right. Yeah.
I guess a smaller one, and probably one that's gone under the radar a little bit. So the ability to recontribute COVID-19 early release withdrawals has been put in place.
That's right. Again, so for those who previously wouldn't have been able to access any of super before the standard conditions of release, so typically retirement or any sort of permanent disability, the government released these measures to sort of help alleviate some fears around loss of jobs and loss of income during COVID, which gave people the ability to access these lump sums over the past couple of years. Now that everything sort of rebounded somewhat in COVID, that is now being this measure is basically being put in place to help people top back up what they drew out and not exceed any of their other caps, which limit how much they can typically put in a year.
Yeah. So quite a niche one, but a good opportunity if people haven't suffered financially to then, get back to where they were. Another one really aimed at younger viewers or potentially children that you may have some interest in giving some good direction for. The First Home Super Save scheme, accessible amount has increased to $50,000. So you can tell us a little bit about that one.
So it's a small increase from 30,000 to which is what is that currently, and that allows people who haven't owned a home in Australia before to put money into super, get a concessional tax rate on those savings, and be able to then draw on that when they purchase their first home. So a slight increase to combat some of the rising house prices. Depending on where you are, that may not be much in terms of a deposit, but it's a little step forward.
Another important one, I guess, supporting the people ageing or working longer in the workforce, eligibility to bring forward non-concessional contributions extended out to age 75, which is quite a significant change. And we've got a table here that reflects, subject to the total superannuation balance rules. So this might need a slightly more, description, Mel. So what's this one about?
That's right. Yeah. So at the moment, with the bring forward non-concessional contribution rules, is that you can essentially maximise your super by bringing forward the next 2 years of non-concessional contributions. At the moment, the limit is 110,000 a year, so effectively 330,000 for the next 3 years, made at in one go. Now, if you were older than essentially 66, you wouldn't have access to that ability to maximise that amount. But now with from 1 July, that will extend up to age 75, which opens up a few opportunities there. And what's important to keep in mind, though, is that it will also depend on your total super balance as to what is allowable as well. So that's a consideration before making any decisions on that.
That's right. And so basically, the government's mandated that you can't have more than 1.7 million in total super balance and still contribute to that. So it is able to grow if you get earnings on that and that sort of thing. But this table just illustrates that depending on your account balance, how much you can put in. The great thing is that even if you're 74 and you've got a super balance lower than 1.48 million, you can put in 330,000 in one go, which previously was a long way away from being able to be done, which is great. So again, supporting people who are still working or still wanting to be able to contribute to their super at a later point in life. We've got some case studies and examples of where this could work really effectively as we go through. Another great one is reducing age pension threshold for downsizer contributions to 60 years or older. So you and I did a webinar last year, I think it was, on downsizer contributions and strategies around that. So I'm sure everybody's watched that and is an expert on how that works, but maybe just explain in brief what that one's about.
Yeah, so the downsizer contribution allows people who've lived in their home for more than 10 years, who haven't, I suppose, thought. I suppose now that their kids have grown and they're empty nesters, too big of a property, this allows them to sell their home, purchase a smaller property, and with the leftover proceeds, contribute into super above the standard limits, up to 300,000 per person. And previously, well, up until today, that age was 65 or older to be able to access this contribution. And now reducing that down to 60 years gives us a little bit more opportunity to make that transition in the home sooner rather than having to wait.
Yeah, this is a fantastic strategy, certainly. I've been working with a lot of clients who've used the downsizer contribution rules over the last couple of years. I think reducing it down to 60, again, gives that opportunity to start thinking about it and preparing that a little bit earlier rather than potentially, having to make all the changes all at once in terms of retiring or contributions. So I think it's a great initiative. So just a reminder, if you do have any questions at home, please type them into the Q&A box and we'll cover those off as we go along. So this is an extension of the minimum payment requirements from account-based pensions and income streams. So as the table illustrates here, that's been effectively carried forward through to the next financial year. Those of you who are accessing an account-based income stream are probably familiar with this one, but for those who aren't or are thinking about how they might access income in retirement, Mel will tell us a little bit about this one.
Yeah. So one of the benefits of building up your super and drawing an income from it is once you convert it into an income stream, it becomes tax-free, which adds additional bump in return there because of the credits and essentially no tax that you pay. So to get that tax-free status, you need to meet the minimum withdrawal from that account each year. And the standard amount is a percentage based on the account balance at 1 July, tiered for your age. So as you age, you are encouraged, mandated to take out more. Yeah. The government wants you to use that money because it is essentially tax-free. So because of COVID again, and the concerns about markets, the government put out a measure to temporarily reduce that minimum percentage requirement by half, which enables people who don't need to draw out that much money to leave more money invested and keep it in their accounts to grow for the future. So that measure was due to end today. That has now been extended for the next financial year as well.
Yeah. And it's always an interesting one. It's, you know, as you rightly said, Mel, the idea is that you've built up this nest egg that you can live on the income and you know, have the desired lifestyle. So we don't want to be encouraging people not to spend the money because you've worked hard to accumulate it, but there are times where it makes sense to try and, I guess, maintain a higher balance or protect the balance that you've generated if you don't need to spend that money. But we'd always encourage you to be, you know, spend mindfully and if you need the money, then take the income, and that's what it's there for.
That's right.
And we'll talk a bit more about that in a case study as well. So that's the changes that have come through. What we're going to talk about over the next couple of slides is just some strategy tips, and we're breaking it down into 3 different categories. So for those who are accumulating super at the moment, there's only a couple of things really for them. So we're not going to spend a whole heap of time, but then we've got some case studies for those who are preparing for retirement and moving into retirement. We've got a couple of questions coming through at the moment. So one of them is a good question. Is the minimum automatic or do you have to ask?
That is not automatic. You will have to set it if it's not already in place. So with most pension providers, you have the option to ask for the minimum, and which will be automatically adjusted if you're already receiving it. So each year as that balance changes, the new minimum will be paid from 1 July. And if not, if you're wanting a certain amount, then that comes out as a, that will stay until you change that instruction.
And that's an interesting one because you have different providers. Some of them you can put down you can nominate a specific dollar amount that you want to get. So that just carries through, provided you are meeting the minimum. But if you are below the new minimum, that changes because, as we saw in that previous slide, every 5 years the minimum increases. So that's something to be mindful of. So on a percentage basis, that kind of can carry through as long as you're meeting those minimums. Yeah. We've got another question in regards to super and investment markets. So we're going to come back to that one. We've got some slides on that at the end, but it's a great question, very topical at the moment. So we'll come back to super and investment markets and how that relates. So thank you for those questions. We keep them coming through. That's great. So as I said, strategy tips in relation to accumulating super. There's a few things that are relevant for those people at that stage. So the first one, I already sort of stole the thunder on this one, check your salary sacrifice arrangements. So we always talk about where possible, you've got a cap that you can salary sacrifice up to. So that's 27,500, which includes your SG contributions. So if your SG contributions are going up and your salary sacrificing, just make sure that that is still, I guess, doing what you want it to do, not exceeding those caps, but if you can, make sure it meets those caps. Olive, and we've touched on the other two there really. So, you know, if you took some money out of super with the COVID measures, then good to think about whether it makes sense to put that back in now or not. And if you're saving for your first home, then investigate how the super save scheme and strategies can work, because they can be quite beneficial in that very unique set of circumstances where you're looking to buy a home.
Yeah. The average sort of tax saving, I mean, it depends, but about 15% of tax savings on that 50,000 plus associated earnings. With a thing to note around the first home super save scheme is that you need to apply to the ATO before entering into a contract. So there's a certain order to be eligible. So if you are intending to take advantage of this, it's highly recommended to have a strategy in place and speak with your advisor around this to make sure that you are actually doing things in the right order to be eligible.
Yep, absolutely. We just had a question come through as well in relation to SGC, the increase. So the question is it correct that if SGC is at 10.5% on income of, say, 300,000, then can a concessional contribution of 31,500 be made, or must the excess be non-concessional?
Good question, Andrew. That one, there is a cap limit of SGC. So the employer will pay 10.5% up to a certain amount. And that basically ensures that you don't exceed the cap from your guaranteed amounts going in.
Yeah. But some employers do choose to pay SG on the whole lot, and that's where these situations arise. Typically then you would have the option to either treat it as a non-concessional contribution, or you'll pay a penalty rate of tax on that anyway. Yeah. So it may be, half a dozen of one, 6 of the other, to whether you pay it personally or through the super fund. So it's good to have a look at that each year and review how you're going to stand in relation to those caps and have a plan to tackle that before it happens. So moving on, strategy tips in relation to preparing for retirement. And I'm going to hand over the mouse to Mel because there's a few things to go through here and some case studies as well.
Yeah, so some of the things we highlighted in preparing for retirement, this is probably where you find the intersection of all the different types of contributions going in to try and maximise that amount before you start drawing down on that. So with that reduction of the downsizer age limit, that opens up things from age 60 for looking at downsizing your home. Also maximising your contributions into super. So the two types, non-concessional, which is essentially your after-tax contribution, typically with 110,000 per year or 330 bring forward. 330,000, I should say. Concessional.
And just on that, there's a couple of things you can think about if you are moving closer to retirement, or you've received a lump sum through an inheritance or a sale of another asset, where you can time those contributions as well. So at the end of a financial year, you could put in 110,000, then you can put in 330 in the next year, so you could get effectively $440,000 in a pretty short space of time. So those types of things are important to think about as you're preparing for retirement as well.
Yep, absolutely. And in terms of the other type of contributions as concessional, which are essentially pre-tax contributions, which give you a tax deduction, either through a salary sacrifice arrangement, through your regular pay, or a personal contribution you make and then claim a tax deduction on at the end of the year in your tax return. Similar to an accumulator, making sure you don't exceed that concessional cap limit through your salary sacrifice arrangement. And there's also a measure there, which we haven't sort of mentioned yet, called the carry forward unused concessional contributions, that allows you, subject to super limits, super balances, to essentially use any cap limits that you didn't use in previous financial years, going back 5 financial years, starting from financial year 19. So that's a bit to unpack there, but essentially if you weren't previously making any contributions into super on top of your super guarantee, you would have an available amount there to top up potentially, which could be used to claim a tax deduction in this or any, going forward any financial year, according to that criteria, subject to that criteria. So that allows us then to, again, maximise the amount we get into super and also get a tax deduction if it makes sense from an income perspective.
And there can be some really good strategies around that, and looking at whether you treat contributions as concessional or non-concessional for various reasons. And we've got a case study that we'll go through over the next couple of slides, or Mel will go through the next couple of slides, which kind of illustrates how that can work as well.
Yeah, that's right. So here's a case study of a couple who are preparing for retirement, Kenny, age 63, and Dolly, age 60. On a very simplified snapshot, they own their own home outright, valued about 1.8 million, have about $50,000 in the bank, have an investment property which still has a small loan attached to it in joint names. Super accounts, healthy at 480,000 for Kenny and 350,000 for Dolly. So total net assets of about 3.43 million. So what they'd like to do, essentially in retirement, downsize and relocate to South Coast New South Wales, retire and maintain a lifestyle of about 100,000 per annum. You know, gives them a very comfortable lifestyle, be able to travel now that the world's opening back up and COVID is more or less normalised. Be debt free, so they don't have to worry about any loans, and also minimise tax where possible. So the strategies that we're looking at for Kenny and Dolly to sell the home, purchase a new home, which would leave them with about 500,000 leftover proceeds. Also, sale of the investment property, repay that debt, gives them about 730 odd thousand left over as well, with an estimated capital gain of about 112,000 each. So looking at maximising their super with a personal concessional, so that's that pre-tax contribution, using that carry forward unused limits from previous financial years that were available to them to get them to about 87,500. A non-concessional after-tax contribution, so taking advantage of that bring forward non-concessional contribution to maximise that amount. And also the downsizer. So 200,000 for Kenny, 300,000 for Dolly to maximise hers, and total super contributions for each of them about 550,500 going into Kenny super and 680,500 for Dolly. So what that means is based on those contributions and the existing super balances, that brings them both to just over 1 mil each in super after the contributions. So the benefits of doing that, so that maximising that concessional contribution, that pre-tax contribution, and using the unused carry forward amounts, nets that has a net tax savings of about 30,700 across both of them on their capital gains that they would have had to pay on that property.
Which is a great outcome.
That's right.
And that's where you look at the different types of contributions, and that's where you can work with that, because they could have just put it all in as non-concessional contributions because they had enough room in their carry in their bring forward caps, so they could have done that. But by looking back and finding out what their carry forward opportunities were, able to minimise that tax, put it in as a tax deductible contribution, which saves them a lot of money.
That's right. Yeah. So maximising the super and the amounts that we've put it in, and also equalising the super benefits across both individuals in the couple to and make it easier to manage as well going forward in what we're drawing. We're all for quality here. Yeah. So with that, drawing 100,000 per annum of tax-free income from their super roughly equates to about 5% of their balances, which is a very manageable, long-term drawdown, and will be within the minimum limits once that increases back up to the standard. So they draw what they use, and they'll be sitting pretty.
Yeah, and as I said, that's a reasonably sustainable amount that you would, be reasonably confident over the long term that they would be able to continue to do that for all their retirement at a 5% sort of drawdown on the original balance.
That's right.
So pretty great strategy, ticks all the boxes in terms of what the goals were showed there, using the different types of contributions that are available to them, and accessing some of the benefits due to the change of rules in regards to the downsizer and their contribution caps as well. So good outcome.
Yeah.
That would probably be a key one. They wouldn't be able to sell the place until tomorrow to maximise the downsizer access.
That's right. Yeah. So some strategy tips for people who are already retired. The primary ones would be looking at reviewing your cash flow needs with the reduced minimums, whether or not that's a viable option to try and keep more money invested and extend the longevity of that pension amount. especially given the current markets and how they've fallen in the last 6 months.
Yeah.
Recontribution strategy. So this is one which is a little bit niche in some ways. So depending on how your your estate planning is set up, but there's two components to your super benefits. So one is a tax-free component and one is a taxable component. When you pay to a non-tax dependent as a death benefit, they pay tax on the taxable component. So where we can try and maximise that tax-free component means more money for your beneficiaries if something happens. So also in amongst that, using that bring forward non-concessional contribution allowable amount now that age has been extended to essentially 75, under 75. Also have the similar additional contribution strategies as the preparing for retirement scenario with the downsizer and concessional contributions if you meet the work test between ages 67 and 74.
Yeah, and we've seen a couple of opportunities just come up in recent times for some of my clients where, again, receiving an inheritance or selling another asset outside. Now, for those people who are already over 67, they can put that money into super, whereas previously that wasn't an option. So that's a great opportunity there if you're looking at planning for those types of things or those things arise to be able to get that money into that tax-free super environment as well. So I've got another case study to run through some of the changes here.
So this is for a retired client, Debbie, age 70, who owns her own home, has about $100,000 in the bank and a account-based pension of $650,000, which she's currently drawing her income from to meet her living expenses. So of that account-based pension, 30% is tax-free, which is roughly around $195,000 worth of that, and 70% is taxable at $455,000. So what that means is for her at the moment, she wants to maintain her lifestyle about $70,000 per annum, so another sort of healthy, comfortable retirement. She has a single beneficiary for her estate, essentially her daughter Carrie, who is a non-tax dependent. So what we mean by that is with super, especially you've got two sort of sets of categories of dependents. So one is a category of under the Superannuation Industry Supervision Act, which essentially outlines four main types of beneficiaries who you can leave your super to. Another categorization is dependent under the ATO. So who's a tax dependent and who's not a non-tax dependent. So there's some overlap, but there's also some differences there. So you can be a dependent for both, a dependent for one and not the other. In this case, adult children tend to be a non-tax dependent, but a dependent under the Superannuation Act. So
that basically means you can leave money to them from your super, but they're going to pay some tax on it.
That's right.
If it's from the taxable component.
That's right, yeah. So trying to, where you do have a non-tax dependent as a beneficiary, this is a strategy that you might consider. Oops, sorry. So for her strategy, given that she has $100,000 in cash as a buffer, elect to draw the minimum, the reduced minimum now for the financial year 23, which is about $16,250 for the year, and use her cash reserves to supplement for her living expenses for the remainder of the year. So that will allow, again, her to leave more money invested in the pension account while markets are down, and just let that recover so we're not selling at a loss. She has cash reserves essentially to see her for about a year and a half comfortably on and still have some left over on that minimum amount. So especially with cash rates at a relative low, that's a good strategy to maximise the assets she has working for her.
Yeah, and I think it's important to note that in Debbie's case, because she can access a super and as much of a super as she likes whenever she wants, it's pretty liquid. So it's, having money inside or outside of super for her is pretty similar in terms of her ability to access. We do like the idea of having cash reserves, but you want to, balance that across inside and outside of super as well. So it makes a lot of sense for her.
And also then that recontribution strategy to help increase that tax-free component. So the reason why this works is when you make a non-concessional after-tax contribution into super, it's considered a tax-free component of your super fund. Whereas if you claim a tax deduction, that automatically forms the taxable component. So that's the main distinction there. So in this next financial year, age 70, she essentially withdraws 330,000 and then recontributes that back into super as an after-tax contribution to use that bring forward provision. Her tax-free component then increases from 195 to 426,000, a big jump. From age 71 to age 72, she can't contribute anything further because she's already maxed out that bring forward provision. And age 73, we want to draw again 110,000 and contribute that back in. So each time we do that recontribution strategy, you would essentially refresh your pension. So consolidate your recontributed amounts, refresh your pension, increase again that tax-free component to 463,000 odd. At age 74, so the last year before she, at this stage anyway with the rules, before she can take advantage of this strategy, again, use that bring forward provision. So even though she won't be eligible essentially from ages 75, 76, you can take advantage of that bring forward provision to essentially get that additional 220,000 that you wouldn't be able to do ordinarily. So that 330, again, withdrawn, recontributed, brings that tax-free component up to 558,384. So I've assumed in this case that the super balance, there's no growth or the changes in the account balance, just to keep things simple, to model from a case study perspective. But this shows essentially moving from 195,000 of tax-free component to 558,385.
And importantly, the income that she's drawing and how that functions from Debbie's viewpoint doesn't change.
Nope.
This is just kind of happening behind the scenes.
That's right.
To change those components. So everything still ticks over for the first part of the strategy, but makes it really beneficial for her beneficiaries to receive that tax-free component.
That's right. Yeah. So the benefits for this, we've got the increase of the tax-free percentage from 30% to essentially 86%, most, from a minority to a majority, which potentially, based on a 650,000 balance, saves about 54,500 in tax when they receive that benefit. I'm pretty sure Carrie would be pretty happy with that. Maximise the pension longevity by reducing the pension amount and drawing on the cash reserves. So, another opportunity there, which we haven't explored for Debbie, would be using that downsizer contribution. She's got a $2.4 million property, which she might need to downsize, and that will give an opportunity to do that. She hasn't used it already.
Yep. Another great question came through as well in regards to how do you find out what the components are of your super, and particularly in this question, self-managed super fund.
Yep. So there will usually be, so if you're in a retail or industry fund, in your member statement would normally have the components and the breakdowns of what's taxable, tax-free. For your self-managed super fund, that will also be in the financials that you do each year when you do the tax returns and the financial reports for your super fund.
Yeah, so your self-managed super fund has the same reporting obligations, so you'll be able to find that, and I can certainly find that out for our questioner and send that through. But keep the questions coming. So just a quick summary of the tips there. So a bit of crossover between the preparing for retirement and retirement, but there are a few options that people can consider. In the interest of time, we'll sort of keep moving, but this presentation will be made available on our website, and you'll get a copy of it through our newsletter, which will go out next week as well. Not next week, the week after. So take your time to run through it at that point in time. So a couple of considerations on those strategy tips before we move on.
Yep, so very quickly, as we mentioned before, that total super balance, which at the moment is at 1.7 million, it sort of dictates how much of these caps and increased limits that we can use for each particular client and scenario. So bearing that in mind when you are thinking about this, to make sure that we are taking this into account so that you're not inadvertently triggering or limiting how much you can put in. Feeding into this is also when you do that bring forward contribution, so you exceed 110,000 in one financial year, that automatically triggers that bring forward. So you don't get a notice, or you're not told now you've activated this, and that limits your future contribution amounts. So you may go into a financial year thinking you have the 410,000, but you may have inadvertently triggered it 1 or 2 years before. So making sure again that you have an awareness of that, so that you're not making an excess contribution into super, which will have tax considerations. So you may pay excess tax if you exceed both your concessional and non-concessional in the same year. You can pay up to 94% tax, which is obviously a very, very large amount.
Yeah, so don't do that.
Yeah.
Great, thanks, Mel. So just really quickly, we had a change of government recently. So it was interesting that in the campaign, and as we've seen on a lot of the big issues, particularly around the economy and finance, they were quite closely aligned on policies. They decided not to diverge as they did at the previous election, when they had some very different ideas. This one, they were pretty closely aligned. So there hasn't been a lot of changes flagged. We've just put up there a couple which the Labor government has flagged they might be interested in, I guess, considering. So that reducing the downsizer age to 55, which makes sense. Doesn't seem like a major drama. Good idea. And a couple of things around social security, Mel, as well.
Yeah, so just giving access to the seniors health card for more self-funded retirees by increasing the income test threshold, and also given the increase in interest rates, freezing the deeming assessment for Centrelink benefits. So that will, give a bit of reprieve for buckets where they're down as well, and maximising their benefits.
Yeah, so they're things which are currently the Labor government's thinking about it and may push forward with. So if they come through, we'll catch up, get Mel back on the webinar, and we'll and sort of talk to you about those ones. So we already had a question earlier, which was a great question, and one we had prepared because it's a pretty common question right now. Is now a good time to put money into super? I guess the first comment on that is I think it's important to separate out super as the great tax environment that it is. And so, where possible, it's always a good time to get money into that tax-friendly, leading to a tax-free environment in retirement. So from that viewpoint, it's always a good time to be looking at your super strategies. But after that, it's then how do you invest that money in super? And that's really where the question comes, is it a good time to be investing in shares and property and putting that money to work in super, which is a good question because there's a lot going on in investment markets at the moment. So Mel's going to talk to us a little bit about, how we're thinking about that and a couple of different strategies to manage that over the next couple of minutes before we wrap up.
Yep. So one of the benefits of, especially when you're doing in the accumulation phase, is the regular investing. So either through salary sacrifice or regular after-tax contribution. After-tax contribution going in. One of the benefits of that is not trying to time the market, but just time in the market. So one of the most powerful things you have in your toolkit for saving for retirement is time. and taking advantage of compounding. So whatever you put in earns income, gets reinvested, earns more income, gets reinvested. So the longer you have the time for that strategy to unfold, the better off you will be when the time comes for retirement. With contributing large sums, so especially in that transition to retirement phase, where you might be taking advantage of a number of strategies and an asset sale or an inheritance that comes in. There's strategies around trying to manage the market risk and the timing risk of putting that in, trying to time the bottom of the market. It's it's like throwing a dart at a dartboard. With a large lump sum, using a dollar cost averaging strategy. So regardless of what's happening in the markets, buying in at the same amount at each time each month, averaging that out over, let's say, a 6-month period helps ride through that volatility through that time. So as the markets are down, you're buying more units, and market's on sale, market goes back up, you're buying less units, and it all averages out over that period of time. So you're not putting all your eggs in at once. Yeah,
we've got a slide here which I think extrapolates out some of that Mel's just spoken to it and really illustrates it quite clearly.
Yep. This one is the regular contributions and that compounding effect. So this is over a 40-year period, which for a younger accumulator, this would be a very typical timeline. Even when you start retirement, at age 60, 65, with life expectancies now to mid-80s, you've still got a very long-term time frame for your investment horizon. So it's not, a lot of people do think that once they start retirement, that's it. It's not, it's just the beginning. So having that, even though markets now are volatile, it's a very short time period in the whole frame of your retirement. So starting off with 10,000 in this slide, starting off with a $10,000 balance. The bottom yellow shaded area is a, no further contributions. You just put it in, set and forget, let the income reinvest. It does have that compounding effect as well. So you can see how it's growing over that 40-year period. So it reaches, $10,000 reaches 800,000 in that time, which is not insignificant. But using that regular contribution strategy, the first shaded blue area, dark blue, of $250 a month over that 40-year period results in a $2.7 million end balance, and $500 a month is $4.5 million. So you can see how that benefit of compounding and regular investing together really accelerates that over the longer period of time. So that's also compounding to demonstrate the benefits of that income that you earn on income that's invested, and it's more about time in the market rather than trying to time when to go in. So these two investors, investor A and investor B, both investing the same amount every year. One starts in the year 2000, only contributes until 2009. So they've got essentially 10 years of investing, both of them. The other one starts in 2010, stops contributing in 2019. So they both put in the same amount of money, 20,000 over that time period. But the one who started earlier and stopped, they didn't have to put in any more money, ended up with a significantly higher balance, 75,000 versus 43,000, simply by being in the market for longer and having that compounding effect.
Yeah. So in the interest of time, we'll kind of look to wrap up, so we know some people won't have to go. But I guess in answering the question, it is now a good time to put money into super, as we said, from a tax effectiveness, from a long-term strategy viewpoint. It probably is. From an investment viewpoint, we certainly look at, if you're making regular salary sacrifice contributions, then just get started, because it's going to work for you over time. If you're making lump sums, then we always advocate dollar cost averaging as a strategy anyway. It becomes much more important in times of heightened volatility and negative market performance like we've seen recently. And it might be a case that you phase out that entry of those lump sums over a longer period of time in these types of conditions, or to help you be a bit more comfortable. So But the reality is, share markets are off. So if you're buying shares, then you're buying shares much cheaper now than you were at the start of the year. So if you've got some cash to put it in, it's not a bad time to start to be investing that money as well. So we do have a few more slides which we won't get to, but they'll be available to you when the presentation comes out to you. So with that, if there's not any more questions, we'll wrap it up. Hopefully we've given you some food for thought. Thank you, Mel, for your expertise and insight. I think case studies were really helpful to bring that to life. If you do have any questions about how any of that may apply to you in your circumstances, please do get in touch with your advisor, and they'll be more than happy to take you through. But thank you very much for your questions from home. That was great to have that engagement as well. And with that, we'll say thank you very much, and thanks for the comments coming through as well. Glad to hear it was informative, and we enjoyed bringing it to you. So have a great day.